everybody. Tonight, we are going to discuss 8 different banking products and principles and how they come together to create the most aggressive and effective debt to wealth program on the market today. We are going to discuss closed-end loans, mortgage amortization, interest cancellation, open-end loans and lines of credit, offset accounts, float and leverage, interest accumulation, and strategic debt payoff. You're going to see how combining these 8 products and principles, you can literally crush and destroy any debt in record time. So what do we know about closed-end loans? Well, first of all, money only goes one way. You could put payments in, but you cannot take any withdrawals out. At bare minimum, it requires a full scheduled payment, and it's driven by an amortization schedule, which means money applied today does not affect interest charges until the following month because it calculates interest charges off of the previous month balance. What did I just describe there? Yeah, that is our mortgage. And friends, the main takeaways are they're very, very restrictive, zero flexibility. And if you stick with your lender's plan, you're flat out going to pay way too much money in interest. So the next principle we want to discuss is mortgage amortization. And throughout our conversation tonight, we're going to be talking about a $400,000 loan with a 6% rate amortized over 30 months. The payment on said loan is $2,398.20. If we look at how this breaks down in month number 1, we see that $398.20 is applied towards principal and $2,000 goes where? To interest. And friends, that's not 6% on any planet. That is actually 83% of your first payment going towards interest. Now, the good news is every single time we make a payment, a little more money is applied towards principal, meaning a little less goes towards interest. So if we take a look at month number 2, yeah, I wasn't kidding when I said a little bit. It's less than a $2 difference. Is it any wonder that it takes this type of loan 30 years to pay off? If we take a look at this mortgage at the end of year number 1, we see that over $28,000 has been paid into it, but the equity position is less than 5. If we take this out to year 5, we now see that we would have paid over $143,000 on this mortgage. We have less than $28,000 in equity, meaning that over $116,000 went where? To interest. Friends, what did that $116,000 buy you? Did you get a couple extra bedrooms on your house? Did you get a few extra acres out back? No, it bought you nothing. It did you just as much good as taking $116,000, lighting it on fire, and watching it burn. Friends, how many hours did you work to earn $116,000? How many hours did you spend away from your family? How many hours did you sit in traffic just to light that money on fire and watch it burn? And the crazy thing is, this is where the average American refinances and starts this vicious cycle all over again. If you think I'm exaggerating, when you go to work tomorrow, ask your colleagues, ask your friends, hey, how many years do you have left to go on your mortgage? You're going to hear 28, 29, 27, 30. I just refinanced. Very seldom do you come across somebody who has less than 5 years or 25 years to go on their mortgage. But let's take this loan out to year 10. We've now paid over $287,000 on this loan, and our equity position is just over 65 grand. Year 21. This is a very special year in our mortgage. We have now paid over $604,000 on a $400,000 loan. But the good news is, friends, we have reached the halfway point. We now owe just under $200,000 on our loan, and we have just over $200,000 in equity. How 21 is half of 30, I will never know. But that's just the absurdity of bankers' math. And if we make every single mortgage payment on time for this entire 30-year period, On a $400,000 loan with a 6% rate, we will actually pay back over $863,000. Friends, that's not 6%. That is 116% more than what we borrowed. You know what I call that? That's legalized theft. It's legal. You signed documents. It's theft. You didn't understand what you were signing. Nobody ever educated you on the difference between a 6% annual percentage rate and 116% total interest percentage. And friends, Albert Einstein once said, those who understand interest are destined to earn it. Those who don't are doomed to pay it. Who do you think understands interest in this scenario? Yeah, the banks, they definitely do. And don't you think it's time that we get smart about our own money? Now, I know some of you are thinking, whew, Di, I dodged that bullet. I refinanced during the pandemic. I don't have a 6% rate on my mortgage. I've got a 2, a 3, a 4.5%. Friends, if you take any notes on our conversation tonight, please write this one down. Rate does not matter. Write it big, write it bold, underline it, give it an exclamation point, go to the chat and tell me you're listening. Rate does not matter. It's how that rate is calculated and the product that you are using. And I'll prove it to you mathematically tonight. So let's take a look at the same loan, but instead of a 6% rate, let's say it's 4.5%. How much are we paying in interest in year number 1? Over 73%. Year number 5, we're still paying over 68%. I refinanced during the pandemic. I have a 3% rate on my mortgage. But if I look at my closing disclosure or my loan estimate, if I make every payment on time based on the bank's plan, I'm going to pay back 51.8%. We've all been warned about the danger of credit cards, but do you realize you are paying more interest on your mortgage than your very worst credit card? And now that we are all thoroughly depressed, friends, don't worry. We are going to move on and start discussing the solution. Our next banking principle is interest cancellation. We're still talking about the same $400,000 loan with a 6% rate amortized over 30 years. And as you recall, when we talked about closed-end loans, at bare minimum, we have to make a fully scheduled payment. So in month number 1, let's do that. Let's pay that $2,398.20. $398.20 goes towards principal and $2,000 goes towards interest. But friends, what if on top of this minimum scheduled payment, we decide to tack on an additional $2,021.06? What would happen then? Well, logic would tell us that if I apply an extra $2,000 and I've got $2,000 going towards principal, I should cancel 1 month off of the back end of my loan. Well, friends, logic is wrong because principal and interest, they are connected. And anything you do to the principal is going to affect the interest. So this single $2,021.06 principal accelerator, it's not going to cancel 1 month off of the back end of your loan, not even 2, 3, or 4 months. This single $2,021.06 principal accelerator, it's going to cancel 5 payments off of the back end of your loan and save you over 10 or just under $10,000 in interest. In any other arena, would you invest $2,000 to make 10? Of course you would. That is a very equitable arrangement. What if we're not thinking big enough? What if instead of putting an extra $2,021 on top of our mortgage, we decided to apply an additional $5,000? And what if it didn't have to be your money? What if it could be somebody else's money? What if it could be your lender's money? What if it could be your bank's money? Do I have your attention? Because friends, that is what we are talking about tonight. So let's move on and talk about open-end loans or lines of credit. What's different about an open-end loan compared to a closed-end loan? Well, first of all, money goes two ways. You can make payments in and immediately take withdrawals out. It requires at bare minimum, not a fully scheduled payment, but an interest-only payment. It's driven by an amortization or a draw period or a repayment period. And this is my favorite part. Money applied today affects today's balance. Literally, you make a payment and the clock stops. They recalculate their interest, they recalculate the principal, and you are charged based on that new balance because it calculates interest off of an average daily balance. Now, Steve, I've got to give you remote control. Here we go.
All righty. Well, folks, this is kind of exciting here. Banking smart. Okay, that's what we all want to do, right? We all want to bank smart. Well, you know what? The bank kind of makes their own rules, and that's what makes them so smart, because they get to make, well, let's make some of our own rules. See, banks understand and use the concept, no stagnant money. Money doesn't sit around at the bank. It's always working. Just like Di said a while ago, you're either earning it or you're paying it. Well, the bank, they believe in making it. They do not let your money sit around at all. So with that, smart investors do what the banks do. Move the right amount of money at the right time from one account to another account. See, here's what we generally think, folks. Di and I have been in the business a long time, okay? People think, oh, you just move money from here to here and that's all you got to do. No, the timing of it, which account, how much of that account, all those things become very important to maximize how you make money. And who better knows that than the banking industry and smart investors who have studied what is the right way to do it. Well, let it sit for the right length of time, because you want to do that. Banks offer what is called sweep accounts. Now, you may or may not have heard of that, but sweep accounts are their astute clients where every day at the close of business, banks sweep the checking and savings accounts of all their clients into a high interest bearing account. Wait, you mean they take those extra dollars and they take them and they do something with it? Every day, every night, 24/7, 365, banks use our money. Well, Steve, I mean, I know that they use our money because they charge me for my checking account. They charge me for my savings account. They charge me for this. Folks, that's the least of the things that they do to take our money. They're also using our money. They relend it, right? At what? 8, 9? Credit cards, 22, 25, 29? That's our money. They're using, it's not the bank's money. It's our money that they're utilizing. Banks use our money to earn interest for themselves while we sleep, relending our deposits. They know money works 24 hours a day, 7 days a week, 365 days a year. There's something called offset accounts. Offset accounts are very, very important when it comes to saving money and maximizing sweep accounts or whatever it might be, but using money and the timing that it takes of where that money's coming from, where it's going to, is so key and so important. You need to use the right type of offset accounts. Interest on offset accounts are open-ended accounts. That's what we're talking about, open-ended accounts. Offset accounts allow you to strategically leverage money to either earn or cancel interest. See, that's a new phrase. See, you can earn interest. We all know about earning interest, or we know about paying interest. Do we know about canceling interest? And how can that be done in the most efficient and effective way? Well, open-ended accounts consist of these types of accounts. Home equity lines of credit, or what we might call a HELOC. That may be familiar to you. Well, HELOCs allow you to cancel interest. Wait a minute. A home equity line of credit allows me to cancel? No, I have to pay interest on it. Well, here in just a minute, Di's going to show you something that's going to blow you away. You can use that account to cancel interest. Checking and savings accounts, we all know what those are, right? This is what we call the initial starter offset account to cancel interest. It's kind of the baby steps as we get started and get going, okay? It may not be the program that you choose to start with, but a lot of people do, because it's a great way to get into the program, learn the program, and become effective at the program. High cash value permanent life insurance. What? Folks, this is not your daddy's life insurance. So don't think about it that way. This is not dying. This is not, no. This is a completely different vehicle than you've ever heard anything about or you've learned anything about. This is cutting edge utilization of a vehicle and the laws and regulations that are available to us to use. A high cash value permanent life insurance plan may not be your way to go, but it may be, but it allows you to earn interest and cancel interest, and is one of probably the only accounts on the face of the planet that will allow you to do that. So offset accounts, sweep accounts, all of those things become very, very important. Oh,
Here at United
Di, hang on a second, Di. I'm sorry, I don't want me to break your thought of thought. I'm so sorry. Folks, Di is an executive director. She's a national trainer. She has tremendous experience and knowledge. I apologize, Di, for not introducing you. Folks, you are listening to one of the most knowledgeable people in our company. Di?
Thank you, Steve. Friends, here at United Financial Freedom, we take advantage of all three of those offset accounts. You could use a line of credit. You could use a high yield savings account. You could use a cash value life insurance policy. Here I am going to show you how to cancel interest using an offset account. And in this example, we are going to show you how to do it using a home equity line of credit. So here we have our $400,000 mortgage that we've been talking about all night long. Now we are going to introduce a line of credit, a home equity line of credit. Remember that $5,000 I said, what if it didn't have to be your money? Well, it doesn't. In this example, it can be your lender's money. So let's say we have a home equity line of credit. It has a $25,000 credit line, and it's at 10%. How many of you with us tonight would use 10% money to pay down 6? Yes, I did say that right. How many of you would use 10 to pay down 6? I know, that's crazy talk, isn't it? It flies in the face of logic. It's counterintuitive. Nobody would use 10% to pay down 6. Now 6 to pay down 10? Absolutely. Friends, if you're thinking that way, it's because the bank has done a fabulous job of brainwashing you. Anybody remember that one little note I encouraged you to take? Rate does not matter. And this is where I'm going to prove it to you mathematically. So we are going to borrow $5,000 from our home equity line of credit to pay down our first mortgage. And when we do that, at first glance, it doesn't look like we've accomplished anything. We still owe $400,000. But what we did do, we took $5,000 from a product we had zero control over, and we moved it to one where we have 100% control over it. And the single strategic funds transfer, it cancels $24,136.34 in future interest, and it eliminates a full year off of the back end of this loan. Now, I know what you're thinking. Well, Di, that looks great, but that $5,000 wasn't free. That was at 10%. You're right. And in month number 1, 10% of $5,000, that payment would be $41.67. How many of you with us tonight would invest $41.67 to save over $24,000 in interest? Friends, that is a very equitable arrangement. But what if it takes more than 1 month to pay back? Okay, let's say it takes 6 months. And let's say that the payment is $50 instead of $41.67. It's not 50. That just makes math a little easier for Di. So what is 6 times 50? That's $300. Anyone willing to invest $300 to save over $24,000 in interest? I should see every hand going up on these questions. You guys, this isn't rocket science. But what if it takes a year? Well, 12 times 50. That's still only $600. Anyone willing to invest 600 to save over 24,000? And now I'm just going to be absolutely ridiculous. And let's say it takes 5 years to pay back this $5,000. Friends, do the math. That's still only $3,000. Anyone willing to invest 3,000 to save over 24,000? At what point does this stop making sense? Well, that would be when it costs us more in interest than it actually saves. And if you do the math out 30 years, that wouldn't even happen. So now that we have mathematically proven that rate does not matter, let's move on to our next banking principle, float and leverage. I bet you all have mastered this one. You just didn't know it had a name to it. Because what do we do when we need gas in the truck? We swipe the card. What do we do when we need groceries? We swipe the card. When the kids need back to school supplies, swipe the card. We need soccer cleats, swipe the card. We use our credit cards every single day of the month. And then what do responsible card holders do at the end of the month? We pay those suckers off in full. We all know that we could leverage our lender's money interest-free for 25 to 45 days, depending upon the card holder, and we literally just float the balance. Again, I've got to ask you, what if we're not thinking big enough? We're just going to add line upon line, little by little. We still have our same $400,000 mortgage at 6%. We still have our home equity line of credit that is now being used as this client's primary checking account. Their net income is $5,000 a month. So when that gets deposited into their home equity line of credit, it pays it down to zero. If we pay the home equity line of credit down to zero in month number 1, how much interest did the bank charge us for the use of their money? Nothing. But what are we supposed to live on? That would be our friendly neighborhood credit card, guys. And yes, I said friendly and credit card in the same breath. Because when you understand how to use the different financial tools out there, they really can be your best friend. So we're going to put everything on that credit card: the groceries, the gas, the school supplies, our prescriptions, our cell phone bill, our insurances, anything we can put on the credit card, we do. And let's say we do that to the tune of $4,000. We're earning rewards points. We're getting sky miles. We're getting cash back. And at the end of the month, when the payment's due, we're going to write one check out of the home equity line of credit, and we're going to pay that sucker down to zero as well. So at the end of month number 1, how much did the bank charge us for the use of their money on the credit card? Nothing. How much did they charge us for the use of their money on the HELOC? Nothing. And we saved over $24,000 in interest, you guys. If this is not fantastic and exciting, I don't know what is. And it gets even better or worse, depending upon how you look at it. Because what if this was your debt? And in addition to your mortgage, you had 5 other debts going out. So there's 6 of them. If this was you, which one of these would you pay off first? Yeah, I know. That one's a loaded question. The gurus can't even agree on that. We've got one guy out there saying, you want to attack the lowest balance and build momentum. Somebody else says, no, you don't. You want to attack the highest interest rate and pay as little as possible. Somebody else says, it doesn't really matter. Just pick one. And then yet another says, hey, let's just put a little extra on all of them. Friends, which one is the fastest mathematical way to zero? Is it the snowball? Is it the avalanche? Is it the middle method? Does it even matter? Well, choosing the wrong one is only going to cost you extra tens to hundreds of thousands of dollars in interest. And if you understand factorial math, with 6 different payments, there are 720 different sequences to choose from. So what's missing? Well, first of all, no one has the systems to do this themselves. No one has the time to do it on their own. It's too complicated to do manually. It's too complex to navigate. There is no strategic payoff. Wouldn't it be nice if somebody would just come up with something like a financial GPS system, something that would tell us when and where and how much of our money to move? Well, friends, we have the answer.
And guess what it's called? Let me ask you a question. You're going across the country, or you're going across town to that specialty shop to find that item that you've been looking for 10 years and they've got it, and it's on some little side street. Here's what we do. We pull out the Rand McNally map. That's what we all do, right? We pull out the Rand McNally and we start with the marker and we're drawing all over the place. Folks, that's anybody that's probably doing any type of program to pay their debt off early, they're using a Rand McNally map to get there, not a GPS. We all get in our car. I get in my car every week, at least 3 times a week. Bump, 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 boom. 2 seconds. It tells me how far it is, when I'm going to get there, what the speed limit is. Tells me everything that I need to know between this point and that point, whether it's 3 miles or 3,000 miles. It doesn't matter. Now, there are some systems other than the GPS. There's the rice and beans, beans and rice guy, and lick the envelope and put some money in. That's technology. That's modern day technology. But so we've got the choice between a Rand McNally and rice and beans and rice and licking envelopes. No, you have a better choice. Modern technology, just like what's in your car. Do you trust your GPS? We all do. It's on our phone. It's in our car. We all utilize it to get where we're going. Wouldn't it make sense that we could use technology, programming, professional programmers that put all this mathematical functionality and algorithms together? Wouldn't it be smart to use something that just tells you what to do? No guessing, and it's mathematically correct 100% of the time. See, just like a GPS, our program constantly recalibrates your game plan when things change, taking every single aspect of your financial situation into account. In life, is everything just a straight road? Or do you have a little turn and curve and twist, and do you run out in the ditch every now and then? Life changes things, doesn't it? Washing machine breaks, refrigerator breaks, car breaks. 1,000 things can happen in our life on a daily basis. Lose your job, make less money, make more money, go on vacation. There's 1,000 things that can happen, folks. Well, guess what? In a GPS, what happens when you pass up the turn? Recalculating. Don't you want to hit that thing every time? Recalculating, but it's going to get you back on track. And you get back on track and you're headed the right direction. Well, guess what? That's what the financial GPS, that's what the Money Max account is. It's a GPS to guide you on every twist and turn. No matter what happens in your life financially, it's going to keep you on the straight and narrow. Income. Do you have multiple streams of income? Do you have a job and you got a couple of other jobs on the side? Are you a commission-based type person, or some months better than other months? If you are, maybe make a little more commission, a little less commission. Amount owed and the term of each debt. Do you know the amount owed on every one of your debts, on every credit card, every debt you have? And do you know what the minimum payments are? And do you know the best times to pay those on each one of those debts? Interest rate, including adjustable rates. You know how to calculate that and where to send the most money if you were going to pay extra. And after tonight, now you know by paying a few dollars extra, you can get out of debt. But folks, can it work? Yes. Won't be close to the GPS, to the MMA though. It won't be close because it is technology. We're using a calculator on our phone, okay? Calculation of payment, different types of amortization schedules. Folks, you don't even have an amortization schedule on your mortgage. The bank doesn't give you one. They don't want you to have one. What's coming, what coming months are down the road? Holiday spending, family vacations, tax return, quarterly taxes, unexpected expenses such as medical bills. Life happens. Then the GPS recalibrates with every change that you have. The quickest mathematical solution to earn the most amount of interest, and pay the least amount of interest. Has any of this made sense? I think so. Di?
All right, let's talk about our next banking principle. This is cash flow and strategic debt payoff. Here we have our checking account, and now we have a home equity line of credit. So how does this work? Well, when you get paid, your money gets deposited into your checking account. The program's going to analyze every single aspect of your financial situation. It's going to honor your minimum reserve and prompt a funds transfer over to the line of credit. When you get paid again, it's going to do the exact same thing. Analyze every single aspect of your financial situation, honor your minimum reserve, and prompt another funds transfer to pay down that line of credit until it reaches an optimal transfer point, at which time it's going to take a look at your debts and tell you which debt or debts to apply the additional principal to. How does this work using a savings account or an insurance product? The exact same way, just backwards. Now, when you get paid, the money goes into the checking account. The program analyzes every aspect of your financial situation. It's going to honor your minimum reserve and prompt a funds transfer over to your savings account or your insurance policy. But instead of paying down a balance, we are now building up a cash reserve until we reach that optimal transfer point, at which time the program will look at your debts and tell you which debt or debts to apply your additional funds to. So if you're using a line of credit, you're paying down a balance. If you're using a high yield savings account or a cash value insurance policy, we are building up a reserve. So now we're going to have a little bit of fun. We are going to take a look at a sample client. Our sample client's name is Steve Jones, and you all are going to be totally shocked when I tell you Steve has that $400,000 mortgage we've been talking about all night. Now, in addition to the principal and interest, we know that there's escrow and there's private mortgage insurance. So Steve's total payment is $2,793.20. In addition to keeping a roof over their head, the Jones family kind of like to stay warm. They like to eat. So we have a few other monthly living expenses that come to the tune of $3,706.80. So their total living expenses are $6,500. The Jones family's net income is $8,000. And if we subtract their living expenses from that, that means they have $1,500 in discretionary income. Do you have to have $1,500 discretionary income in order for this program to work? Absolutely not. As long as you're not spending more than you earn, this program can help you get out of debt in the fastest mathematical way possible. Do you have to have a home equity line of credit? No, we already addressed that. You could use a high yield savings account or an insurance policy. This is just the example we chose to use tonight.